5 assets that went up during economic collapse. Gold, the apocalypse insurance. When currencies collapse and governments panic, gold just sits there being shiny and valuable like it has for 5,000 years. It doesn't care about inflation, it doesn't care about your central bank's printing press working overtime, it doesn't care that the stock market just lost 40% in 6 weeks. During the 2008 financial crisis, the S&P 500 dropped 57% from peak to bottom. Gold? Up 25% over the same period. When Lehman Brothers declared bankruptcy and everyone was losing their minds, gold was quietly becoming more expensive. Why? Because when paper assets are burning, people remember that gold is the only asset that isn't simultaneously someone else's liability. It's not a promise. It's not a claim on future earnings. It's just gold. You own it, physically, and no bank can make it disappear with creative accounting. During the Weimar Republic hyperinflation in 1920s Germany, people who held gold could still buy groceries. People holding cash needed wheelbarrows full of bills to buy bread. The downside? Gold doesn't pay dividends. It doesn't generate income. It just sits there, maintaining purchasing power while everything else collapses. That's not exciting, but when your neighbor's losing his house, boring starts looking pretty attractive. Real estate, the tangible survival play. This one's tricky because real estate did crash in 2008, so why is it on this list? Because despite the crash, physical properties survived. The buildings didn't disappear, the land didn't evaporate. Prices dropped, sure, but people who held on through the storm still owned something tangible that recovered. By 2012, real estate was climbing again. By 2020, it had surpassed pre-crash levels. Compare that to Lehman Brothers stock, which went to literally zero, or Bear Stearns, which imploded and ceased to exist. Real estate, even in a crisis, has intrinsic value because humans need shelter. You can live in it, you can rent it out. During economic collapse, people still need places to sleep. In Venezuela's economic collapse, owning property became one of the few ways to preserve wealth while the currency disintegrated. The bolivar went from 10 per dollar to over $1 million per dollar. Cash became toilet paper, but an apartment in Caracas, still an apartment, still worth something. The key is buying below your means and not over-leveraging. The people who got destroyed in 2008 were the ones who bought maximum house with minimum down payment and adjustable rate mortgages. They were gambling. The people who bought conservatively with fixed rates and significant equity, they weathered the storm and came out ahead. Treasury bonds, the government's IOU that actually pays. When everything's collapsing, U.S. Treasury bonds become the safe harbor. They're backed by the full faith and credit of the United States government, and despite all its problems, the U.S. has never defaulted. During the 2008 crisis, while stocks were cratering and banks were failing, U.S. Treasury bonds surged. The 10-year Treasury yield dropped from 4% to 2% as investors fled to safety, which means bond prices went up significantly. People were so desperate for safety, they were willing to accept lower returns just to know their money would still exist tomorrow. Even during the Great Depression, Treasury bonds held value. Stocks lost 89% from 1929 to 1932. Companies went bankrupt, banks failed, but Treasury bonds, they paid out. The interest kept coming. You didn't get rich, but you didn't get wiped out either. The catch is that bonds don't protect against inflation the way gold or real estate might, and if you believe the U.S. government might actually default someday, this strategy falls apart. But historically, when markets panic, money floods into treasuries like a lifeboat. It's not sexy, it's not exciting, but it's predictable safety when nothing else is. Dividend-paying blue-chip stocks, the companies that won't die. Not all stocks are created equal. When the economy collapses, speculative tech startups and meme stocks get obliterated. But companies that make toilet paper, toothpaste, electricity, and cheap food, they keep chugging along. Procter & Gamble survived the Great Depression. It survived 2008. It'll probably survive the next collapse because people still need to brush their teeth during recessions. During 2008, yes, P&G's stock dropped. Everything dropped. But the company never stopped paying dividends. Johnson & Johnson has paid increasing dividends for over 60 consecutive years, including through every recession, crash, and crisis. Coca-Cola, Colgate Palmolive, utilities, these boring, unglamorous companies that make everyday products people can't stop buying. They might lose 30% in a crash, but they don't go to zero. They don't declare bankruptcy. And those dividend checks keep depositing into your account even when the market's burning. That's the key. It's not about price stability, it's about income stability. When your tech stocks are down 70% and you're panicking, your dividend stocks are still paying you quarterly. That income is psychological armor. In the Great Depression, investors who held dividend-paying stocks could live off the income even as prices cratered. They didn't have to sell at the bottom, they could wait it out. That's the survival mechanism, passive income that continues regardless of what the market's doing. Farmland and agricultural assets. The bet on hunger. Here's a depressing reality. No matter how bad the economy gets, people need to eat. Farmland is the ultimate inflation hedge and collapse insurance because food demand never disappears. During Germany's hyperinflation, owning farmland meant you could grow food, which was infinitely more valuable than currency. During the Great Depression, farmland prices fell, but the land still produced crops. Farmers still grew food. People still needed to eat. Fast forward to modern day. Farmland has appreciated an average of 6% annually for decades with remarkably low volatility compared to stocks. During 2008, while the S&P 500 was collapsing, farmland values barely budged. Why? Because corn, wheat, soybeans, people need those regardless of what Wall Street's doing. Bill Gates is now the largest private farmland owner in America. He's not doing that for fun. He's positioning for long-term food security and inflation protection. The catch is liquidity. You can't sell half an acre on a Tuesday afternoon if you need cash. Farmland is illiquid and requires significant capital to acquire. But as a long-term collapse hedge, it's hard to beat. You own a tangible asset that produces food, which is literally humanity's most basic need. Currencies can collapse, stock markets can crash, governments can fall, but people still need to eat, and whoever controls food production controls real wealth. Here's the truth. You can't predict exactly when the next collapse will happen. Could be next year, could be in 20 years, but it will happen, because collapses are built into the system. Booms create bubbles, bubbles pump, markets crash, the economy resets. It's happened dozens of times throughout history, and it'll happen again. The question is whether you're positioned to survive it or whether you're holding assets that evaporate when the music stops. Diversification across these asset classes isn't about getting rich. It's about not getting destroyed. It's about making sure that when your neighbor's entire net worth disappears because it was all in one speculative asset, you're still standing because you spread your bets across things that have survived every previous collapse. Gold, real estate, treasuries, dividend stocks, farmland. These aren't sexy. They're not going to 10x in a year, but they've survived wars, depressions, hyperinflations, and financial crises. That's the track record that matters when everything else is burning.